Disney just reported their latest quarterly figures, a double beat, plus we also got outlook for fiscal 25, 26 and 2027. At the time of making this video, the stock is up 8.2%. It will have a market cap closer to $200 billion and its dividend yield sits at 0.88%. It has a forward PE of 20.3 times. Now, yeah, it's true that Disney over the last couple of years, definitely not a good stock to own, right? It's down 30% or so in the last 3 years. Year to date, it's up 14, well, it was up 14% before the earnings report. Now it's going to be closer to 20%. So, okay, it's catching up, but still underperforming the market. But I do think that, well, the worst is behind Disney. That's just my opinion. I've talked about Disney, I think it was in the August or September stocks to buy video when the stock was still in the $90 or so. Of course, it's been in $90 before. Maybe it's going to be $90 in the future. I don't know. I would bet that it does not see $90 anymore. But then again, I've been wrong. Now, in this quarter, you will see that, well, there are some segments of Disney that are actually doing better than expected. And that's, of course, the streaming side of things, the direct-to-consumer side. It's becoming more and more profitable. And so Disney as a company is becoming more and more profitable as well, free cash flow-wise and earnings as well. So all in all, good quarter. Sentiment is definitely changing. Now, of course, content-wise, you can love the content, you can hate the content. I think we can all agree that Star Wars is not the same Star Wars as before, but for example, they had Inside Out 2, right? Inside Out 1 was already, I think, a money-making machine for them. Inside Out 2, even better. Deadpool Wolverine, also great for them. Hulu TV shows are doing exceptionally well. So the Disney brand is not just Disney movies, Disney branded movies. No, it's the IP that the Walt Disney Company owns. Of course, they had a decade plus of success with Marvel movies. Now, Marvel, maybe superhero fatigue or maybe just bad content is the reason why it's not as successful as before. But then again, if you're bringing back Robert Downey Jr. as Doctor Doom, yeah, you know very well that it's going to break $1 billion in the box office. So at least that's what I'm expecting. Anyways, we're going to have a look at the earnings report. I'm going to be releasing a couple of videos today about JD, about some other companies as well. So stay tuned for that. Like, subscribe, do all of that. We'll really appreciate it. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. I'll first start by saying that Nelson Peltz completely sold out of his Disney position. All gone. This was 6.4% of the portfolio, and now all of the shares in Disney are gone. This was the activist investor that was trying to get, well, Disney back on track, trying to get a board seat as well. A little feud between him and Bob Iger. Okay, Disney won in this case, and he's completely out. As for the expectations, what the market was expecting for Disney and what it is expecting for the next couple of fiscal years. So first of all, we can see here for September 2024, because their fiscal year has already started for fiscal 2025. Right now, $7.756 billion in free cash flow. As you will see in this quarter, it's already higher than that. So free cash flow is expected to grow faster than revenue growth, but you will probably see these numbers being adjusted in the next couple of days. So I'll start with a couple of comments from Bob Iger, the CEO. This was a pivotal and successful year for the Walt Disney Company, and thanks to the significant progress we've made, we have emerged from a period of considerable challenges and disruption, well positioned for growth and optimistic about our future. Our solid performance in the fiscal fourth quarter reflected the success of our strategic efforts to improve quality, innovation, efficiency, and value creation. In Q4, we saw one of the best quarters in the history of our film studio, improved profitability in our streaming businesses, a record-breaking 60 Emmy Awards for the company, the continued power of live sports, and the unveiling of an impressive collection of new projects coming to our experiences segment. As a result of our strategies and our focus on managing our business for both the near and long term, we are differentiating ourselves from traditional competitors, leveraging the deepest and broadest sets of entertainment assets in the industry to drive attractive returns and further advance our goals. Hopefully the goals are to make magic and not something else. And so the results for the quarter are as follows. Revenue increased 6% year over year. Total segment operating income up 23% year over year. This year, fiscal 2024, was basically the year where, well, the year over year comparisons from a profitability standpoint look incredible because fiscal 2023 was just so horrible. And so you're seeing this right here, right? Operating income up 23%, diluted earnings per share up 79%, cash from operations up 15%, and free cash flow is up 18% year over year. Or if you look at the full fiscal year, free cash flow is up 75% year over year. Diluted earnings per share over 100% increase year over year, while revenues only increase 3%. So it's really the profitability side of the business that has improved tremendously. As for the different segments, so we've got the entertainment one, sports, and experiences. So the entertainment one has increased 14% year over year, revenue-wise. Sports is basically flat. Experiences up 1%. Now looking at operating income for each segment, so entertainment side, direct to consumer side, that's up 100% year over year. There's also linear there, but as you will see, linear is basically struggling. It's DTC that is doing much better. Sports is down 5% and experiences down 6% as well. You will see in a second why. So first up, we start with entertainment. So as you can see, linear network down 6% year over year. Direct to consumer is up 15%. But this time, we can see that direct to consumer is actually contributing $253 million to operating income. Linear is actually decreasing 38% year over year to have close to $500 million. As for the subscribers and ARPU, so we can see that Disney Plus Core increased 4% year over year. I believe it's also up a little bit quarter over quarter. Disney Plus Hotstar is up 1%, but as you can see, Disney Plus Hotstar from a ARPU perspective is really not that much. It's down 26% year over year to 78 cents. Disney Plus Core is up 1%, and that's, an ARPU of $7.30. If you look at Hulu, that's basically up 2% year over year. When the ARPU for Hulu SVOD only is $12.54, that's down 1%. And Live TV plus SVOD is basically flat year on year, $95.82. As for the experiences side, so domestically they're up 3% year over year revenue-wise, but internationally that's down 5%. And it becomes even worse if you look at operating income. Domestically up 5%, but internationally down 32% year on year. Basically, they said lower volume, lower spend per guest is contributing to that. So remains to be seen what happens. Maybe it has become too expensive. Switching to a guidance here, they say for fiscal 2025, we should expect high single-digit adjusted EPS growth compared to fiscal 2024. That's better than what the market is expecting right now. Approximately $15 billion in cash provided by operations, approximately $8 billion of CapEx, their target dividend growth that tracks their earnings growth, targeting $3 billion in buybacks. As for the entertainment side, double digits percentage segment operating income growth compared to fiscal 2024, weighted to the first half of the year. They see a modest decline in Q1 Disney Plus Core subscribers versus Q4. Q1 content sales, licensing, and other operating income relatively in line with Q4 as well. As for sports, 13% segment operating income growth compared to fiscal 2024 on a reported basis. Then for experiences, 6 to 8% segment operating income growth compared to fiscal 2024, weighted to the second half of the year. They say here Q1 operating income adversely impacted by approximately $130 million due to the hurricanes Helene and Milton, and approximately $90 million due to Disney Cruise Line pre-launch cost. As for fiscal 2026, here we can expect double-digit adjusted EPS growth, double-digit growth in cash provided by operations, and for fiscal 2027, also the expectations are for double-digit adjusted EPS growth. Now, before we conclude this video, I just want to do a quick reverse DCF here just to show you if it's too expensive, if it's too cheap. So free cash flow trailing 12 months, $8.559 billion. Terminal growth rate, 4.44%. The 10-year yield is going up and up and up, and that's basically what I'm basing myself on. You can like it, you cannot. You can basically do this yourself as well. And then the discount rate 8.48%. It's basically taking those two things here, terminal growth rate and implied equity risk premium, 8.48%. So the implied growth rate with a 2% dilution is 5.6% to justify the price pre-market, which is around $109, $110 or so. Implied growth rate of 5.6% for the next 10 years. Do you think this is too expensive? Do you think this is too cheap? Let me know down in the comment section below. And so looking at the charts right now, we can see solid momentum with Disney stock since that, August 5th Black Monday event. Since then, solid momentum each and every week. Stock basically manages to go up and up and up. In the last couple of weeks, we did go above the 200-day moving average, and now we're going to go much, much higher. We're probably going to be very close to being overbought. But then again, when you've got the momentum, when the markets are green, when you're showing strength in your business, then just being overbought is not an excuse for you to come down. The next point of, interest here is probably, or resistance is probably going to be $124. That was the previous resistance, the previous stop here back in April of 2024. So let's see what happens. But all in all, good quarter, good comments, guidance, overall business is quite good at Disney right now. And to be honest, I think they learned their lesson. I'm not 100% sure, but I think. So all in all, good quarter. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.